Hi, I'm David Busch, Co-Chief Investment Officer for Trajan Wealth. I'm here in New York City where I had the opportunity to speak with the Schwab Financial Network live from the NYSE floor, who spoke about today's market action and the impact that the Fed decision will have on markets. I even go into which sectors I think will perform well in 2026.
Joining us now is David Busch, Co-Chief Investment Officer at Trajan Wealth. Thank you so much for joining me.
Thank you, Sam. Glad to be here.
So we got past the Fed.
Yes, we did.
And what did you think of it? I mean, what did you make of, the big story that seemed to be the takeaway? That was the QE light or mini QE. That seemed to have caught a lot of attention yesterday. Also, some of the commentary around, the labour market cooling, which you thought that stocks would have sold off on. But it seemed that it was, his maybe less concern around inflation that sort of managed to balance it out.
Yeah, it was interesting. So we can start with the non-QE QE. So the Fed basically announced that they're going to buy $40 billion worth of treasuries every month to shore up liquidity. And what's interesting is they're going to be buying 3 years and in. And so I would expect the yield curve on the front end to come down. Now, how that has translated is, yes, Jay Powell did say that we have continued inflation and persistent inflation, but we also continue to see the softening labor market. This morning we had initial jobless claims came in higher than expected. And so one of the key takeaways that he said in the press conference is that essentially they all agreed that they have persistent inflation and softening labor market, but had different ideas on how best to get there. And that's why we saw 2 dissent for no rate change and 1 dissent that wanted a 50 basis point rate change.
So it's no surprises there where we've got a divided Fed. I'm just wondering, as they pencil in perhaps 1 cut for next year, what you're modelling right now as far as, when that could be, and particularly given a lot of the conversations around who is likely to replace Powell as well. And you mentioned the steepening yield curve. Obviously, we've seen a reaction to some of the names around the potential front runners there too. That's
right. So we'll continue to see that steepening of the curve. But with the potential front runners, I would expect them to come in and be very dovish, especially if President Trump nominates them. So it could change the makeup of the Fed and, push them to drop rates further. Now, the one benefit from lower rates is it's a tailwind to tech companies. It's a tailwind to small caps and mid caps. So that's why we're seeing the rally today. We're in small and mid cap, but with the S&P, it's down. And the reason is because some of those tech names, Oracle specifically, there's a recognition that there's going to be increased capital expenditures to build out the AI infrastructure. And valuations were already high. So what I anticipate is that eventually these tech companies will be able to monetize that AI technology. But in the near term, we're going to see some price action and potentially some volatility due to those capital expenditures.
Let's switch gears, just because you brought it up. Obviously, the push and pull in the market seems to be some of the concerns around the whole AI trade, particularly the circularity of financing. I think, Oracle has been such a big focus of the market, particularly because of the CDS spreads. They're tapping the debt market to fuel their AI ambitions. And obviously, we've seen this sell-off this morning. I mean, it's down in double digits. It's our loser on the day. I heard a quote this morning, and I've mentioned it a couple of times on this show already, that somebody sort of has this view that I heard today about the fact that maybe this sell-off is normal and it's good because it shows that the exuberance is not irrational, that it is rational. Because if you have some concerns around that capex, then obviously we're seeing a little bit of pullback. That goes to show that that's something that investors are thinking about. Would you agree with that?
Absolutely. Because valuations have been high, we've seen investor and consumer sentiment falling, and I think that there was a growing concern about those valuations, and we're going to have volatility due to headline risk. Days like today where Oracle announced their capital expenditures. But ultimately, I'm a firm believer in tech. And this is the wave of the future. And so I think long term, it's going to be fine. But in the near term, we're going to have this short term volatility. But we're also seeing a broadening of the market. The Dow Jones, the industrials, if we look further into those sectors that are going to be key in building that AI infrastructure outside of tech, I think we'll do well.
And where do you look for opportunities right now as we head into 2026? We've been talking about the rotation. Obviously, it's sort of been a value v growth, cyclical v defensive type trade. Yesterday, we did see a nice rally for the Russell 2000. Where do you see opportunities as we sort of head into the new year with, as you say, the markets may be expecting a very dovish Fed?
That's right. So on the fixed income side, I think investors would be wise to lock in current yields, like in that 3 to 5 year range, go up in quality, IG corporates, treasuries, be mindful and selective on high yield. But from an equity allocation perspective, I would stay invested in large cap growth, large cap tech, but I would balance that with a value tilt and specifically dividend payers, because that'll help offset some of the volatility that we may experience from days like today with tech selling off.
Okay, so lock in the short end right now with the expectation that rates will come down further. I mean, particularly around the middle of next year. You talk about large cap tech. I mean, anywhere else where you see opportunity, are there any sectors which really stand out to you? I mean, utilities have been catching a bid. Healthcare has been really catching a bid. It looks like it's going to have a good year next year as well.
That's right. With sector rotation, specifically healthcare, but also if we look down into those sectors that are going to benefit from this AI infrastructure build out, it's going to be materials, it's going to be builders, it's going to be utilities, power, energy. All of those sectors should do well to help support that AI infrastructure build.
And then obviously we've got financials, which would obviously benefit from the steepening yield curve as well. At least that's a conversation in the market. So we could be looking at a good year for some of these sectors. We have to wrap it up there, but thank you so much, David, for joining me this morning, and have a good rest of your week. That is David Busch there, who's the Chief Investment Officer at Trajan Wealth.
So what do you think? Which sectors of the market should perform well in 2026? And how should you position your portfolio? Let me know in the comments below, and don't forget to like and subscribe for more.